So we have finished till cognitive errors. Today we are discussing from behavioral biases. So pet projects of senior management. So pet projects are kind of dream projects. That means they want to do certain project irrespective of the outcome or irrespective of whatever the results are going to be. They're not bothered about the results. That is not something which should be typical of some like management of a company. Let's say I want to build a, I want to, start a project, and that's my dream project. I want to build a big hotel, let's say, irrespective of whatever the cost it's I'm going to incur, and that to this hotel should be in some prime area, and I've spent very big amount, huge amount for that, and now the hotel is not working out. Then what? Because of the severe competition in that area. There can be a number of reasons. But as I was adamant that this is going to be my dream project, I've put all my resources or money in this, and now I lost. And I can give you the best live example, Kingfisher Airlines. You already know Kingfisher was owned by the Vijay Mallya. Okay. And what Vijay Mallya has done, he has committed a big fraud and lot of money, SBI, he has created a fraud, and the banks lost a lot of money who have lent the money to Kingfisher Group. SBI lost a lot of money in that 9,000 crore worth of fraud he has done. Now he is in London right now, and hiding in London. Okay. And Kingfisher Airlines was not something which was recommended by the board of Kingfisher Group or Vijay Mallya Group, or whatever you want, you can say, or United Breweries. Already he was one of the biggest. He had one of the biggest companies in liquor, but then he wanted to, start a new business or enter into a new kind of business in which he did not have any experience, and he wanted to give a luxury kind of travel during those days, whereby the Indian crowd was not having that capacity to afford luxury travel in an airline. So then what happened with the mistakes of Kingfisher, Indigo and SpiceJet have come with budget travel, budget airlines these are called. Okay. So then what happened is Kingfisher Airlines, it because of this they have gone bankrupt and they defaulted, and then at the end a fraud was committed. So that was the pet project or dream project of that group, and henceforth they were very optimistic that they would be making it profitable, but at the end the results are in front of us. So these kind of things also are something which happen while picking up a project, and that is one of the first ones under behavioral biases. So bias is what? Confusion. Okay, you're not stuck on something. Next, inertia in setting the entire capital budget. So they don't want to change, it seems. They don't want any changes to happen. That is what is inertia. So capital budgets for many companies are similar from one year to next. This indicates anchoring of capital budgets to the prior year rather than appropriately considering what opportunities exist every year. So what they do is the same stereotype, the same thing what they made the previous year, the same thing they put it in the current year as well. They don't expect like something new would come in and something new would happen in their business, and they may get some kind of opportunity, and they don't consider all these factors. So in a company with a culture of maximizing shareholder value, managers will return excess funds to shareholders whenever there's a lack of positive NPV projects, and make a case for expanding the budget when there are multiple positive NPV opportunities. So that's what they do. If they are not able to get good returns, they'll give back the money. Okay. And if they're getting good returns, they may try to expand the budget when there are multiple positive NPV opportunities. Analysts should watch for companies with static or rising. Static is like kind of fixed, or rising capital budgets, incremental capital budgets. coupled with declining returns as a sign of this bias. Okay, sometimes they also should also consider declining returns as well. That can also be a possibility. It's not like always you'll be getting some high returns. There can be declining returns as well. So that cannot be ruled out. So if you are not considering those factors, then you are biased. So biased is what you are like only aligned or inclined towards like one thing. Okay, not considering there can be like two aspects. Only you are only looking into the profit aspect. That means it will be only profitable. You're not thinking that there can be losses as well at times. So you're biased, right? You are like partial. That's what is called partiality. Basing investment decisions on EPS or ROE, not a good sign. This can be two parameters, but not the like ones on which you will take your final decision always. So managers whose incentive compensation is tied to increasing EPS or ROE may avoid positive long-term NPV investments that are expected to reduce EPS or ROE in short run. So if they keep this as parameters, and they may get very good returns if they show higher EPS and higher ROE. So at times showing these two, they may tend to leave some good projects which they may have an opportunity to take up. So then what happens in long run, that may reduce their EPS or ROE. Okay, so these people what they do is they want to show gains in short term, and for that reason they avoid something which can do wonders for them in the long term. So they are biased, right? So they want to show higher returns in short span of time and want to get good remuneration and incentives or compensation for the, and what they do is they leave some long term um, fruit bearing or fruit giving projects or profitable projects. That is what is a biased approach what they have. Okay, so failure to generate alternative investment ideas. So they stick themselves to something very stereotyped, like generating investment ideas is a crucial step in capital allocation process. However, once a manager comes up with a good idea, he or she may go with it rather than searching for an idea that is better. That's what. So they think that what they have bought is a good one, but there can be better ideas than this. Who knows? Now, describe types of real options relevant to capital investments. Real options are future actions that a firm can take given that they invest in a project today. So if you start some good project today, in future, some actions you can take up. If you don't start a business, see, once you have entered into a course, CFA program, in future you can think of cracking this examination. If you don't enter into this course, then how come you can think of cracking an examination? Real options are similar to financial options, put and call options. You know what is put option and what is call option? This is option to sell, and call option is option to buy. And an option gives you a right. Right means you get a right to either buy or sell something in the future whose price you fix today itself. Okay, so we will discuss about options later on when we'll be starting derivatives topic. So like what happens, real options are similar to finance options in that they give the option holder the right but not the obligation to take a future action. Of course, so in case of options, you have a right, but not an obligation. Let's say you want to take admission in a school. Okay, so you buy the admission form of that school, right? So in future, if you want to take, so let's say 1,000 rupees is the cost of that particular admission form. In future, like after the interviews are done, still you have the chance, still you have that, you've got that particular right of taking admission in this particular school, uh, or you can also skip this school and go for another school if you have taken admission form of that another school. So this admission form what you have taken has given the right to you to take an admission in a school provided you crack all the interviews and you are eligible to take admission in that school. Okay, or else if you don't want to take admission also, you can skip. That means, see, you will only take admission if it is beneficiary for you, right? If it is not beneficiary for you, if you don't like the school, if it's far away, if the faculty is not good, you have done a good research in 6 months, you may also skip the admission in that school or cancel the admission in that school and take admission in some other school. Done. So the minimum loss what you have here is only this 1,000 rupees, the form fees. Otherwise, if you would have not taken this admission form and you would have come directly after 6 months and taken admission in the school without proper inquiry or something, and because the schools give direct admissions as well, then you cannot claim your money from that school, because now you have put your money, the admission is confirmed, and then you have to enroll the kid in that school. So no other, you have here an obligation is created because you have directly approached the school. Interviews are done. You did not fill any admission form, anything, nothing like that beforehand. So you have directly taken the admission, paid the fees, and done, finish. Now it's an obligation for you to continue with the school. But in this case, if you've taken admission form, this is giving you a right to take admission, but not obligation. Obligation means it's not compulsory that you should take admission. You can cancel the admission if you don't like the school. So the value of real options could enhance a project's NPV. So we will see the options also. Don't worry. Options never have negative values, because I already told you here, option will not have a negative value. Never. Let's say I will give you a like practical example. There is a stock, SBI stock, which you want to buy. Okay, but you are worried that if you buy that stock for 100 rupees today and in the future the price goes to 70, you want to buy the stock for 100 rupees today, and if the stock value goes to 70 rupees, you may incur a loss, right? Fine, that's understood fact. So how come you can like save yourself from these losses? Okay, if it goes up, then that's okay. If it goes down, then you're in losses. So you can go and you can trade in options. That means you can take an option from an option dealer, option writer, option seller, whatever you want to say, you can say. In our example, the school was the option seller. They were selling the option to take admission, which is nothing but the admission form. In this also, in market, there are lot many brokers like Zerodha or Upstocks, or the brokers they have, or the writer or option sellers, they have options with them. So they will sell you an option to buy the stock of SBI Bank. So let's say this is the month of February, June call. That means June call option for SBI stock is available in the option market, and per stock is like the strike. That means today itself you are like like taking an option to buy the SBI stock in the month of June. So today itself you are buying an option okay, or you're taking an option, not buying an option. I'll say you're taking an option, or you're making an option contract, would even be more better terminology. You are making an option contract to buy the SBI Bank stock in the month of June, okay, on June 30th, at a fixed price or a predetermined price today itself. That means you are fixing the price today itself at which you are going to buy the stock of SBI Bank in the month of June or on June 30th. And the price what you fixed is 100 rupees, or SBI call option or SBI call is available for 100 rupees as on today, right? So SBI call is available as on at 100 rupees today. So I can say this 100 rupees is the strike price. That means this is the price at which you will be buying the SBI stock, because you have taken a call option, and call option is option to buy. After 3 months, that is from like this is Feb, March, April, May, June. After 4 months, the day has come when you have to exercise your option. Now again I'll say you have a right to exercise, but not an obligation. On that particular day of June 30th, the SBI stock is trading at 180 rupees. Now you see that you have a good benefit. You can buy the SBI stock from the options market, okay, and then you get the SBI stock in your hands. You can go to the spot market or stock market and sell this 100 rupees stock for 180 in the stock market or spot market, right? You can buy 100 rupees you can buy the SBI Bank's stock at 100 rupees on June 30th in the option market because the strike price is 100. That is the price at which you have made the option contract, okay, to buy SBI stock, whose price was fixed 3 months or 4 months back in the February month. And now the day has come, the maturity day has come. So you can buy the SBI stock for 100 rupees and you can sell that for 180 rupees and you can make a gain of 80. And don't forget this option, what you have taken, you have not taken it for free of cost. So let's say for one stock, they are charging 10 rupees as premium. So SBI, so what is the value of call option? Value of call option is 80. What is the profit for you? The profit for you is 80 minus 10, 70. You have deducted the option premium. This option premium is like if you have taken admission in the school fees happens to be 10,000 rupees. Out of that 1,000 rupees you have paid for admission form fees. Okay, so the net, here, or else I can say the total expenditure for you would be 11,000 in this case. Okay. Okay, in this case, because here nothing, you're not, it's not like you are waiting for price increase or decrease or nothing like that. Here 11,000 is the fees and 10,000 is the fees and 1,000 is your form admission form fees. The total cost for you is 11,000. Here you have made the value of the option or the derivative what you have taken here is options and it has derived its value because of the increment in the underlying assets value. The underlying asset here happens to be SBI Bank stock. So it has gone to 80 and 10 is the premium, 70 is your profit which you take home. Okay, that's what. And then in this, and then there is one more option which is put option, which is the option to sell. One more thing I would tell you, the best thing about options, okay, is let's say if the stock price has gone to 180, that's okay, you have exercised the option, but the stock price has gone to 70, it has reduced. Now what benefit you have is, since the option is not worthy for you, it is a loss making deal for you, you can skip this. Okay, okay, and the minimum loss for you would be only the 10 rupees premium what you paid to take this option. That's it. Okay, so options will only be exercised if the prices will go up. In case of call option, if the prices go down, you will not exercise the option. Just the minimum loss for you will be 10 rupees premium paid to the option writer or seller. Now put option. See, I'm only explaining you because there are lot many times they're using this word called options and many of you, some of you may be knowing what these are and some of you may not be knowing. So I have to explain you about this with some good example. So again, put option also I will explain you because they have taken out the name call and put option. Put option is option to sell. So let's say you have taken a put option and that is the June put of Kotak Bank. Kotak Mahindra Bank is available for let's say 50 rupees. Okay, that means you can sell the Kotak Mahindra Bank stock for 50 rupees on June 30th. Okay, and the June 30th day has come and on that day the stock price has gone to 30 rupees. So what happens? You have taken the contract to sell. Okay, that means you have taken a put option as per which you have the right to sell the Kotak Mahindra Bank stock at 50 rupees. Okay, and this price has been fixed the day on which you made this put option contract. Now, as if you have to sell, you can exit from this particular deal only by buying. That means you have taken a sell option, you have to buy and you have to exit. So you can buy at 30 and sell at 50 and you can make a profit of 20. But mind it, the profit is 10 here because 10 is 5 here. 15 here because 5 is the option premium we have paid to option writer. So 15 is the profit. Value of the put option is 20. Okay. And let's say if the prices goes to like 50 is what here, 30 is it has got reduced, we've got profit. If it goes to 100, then you have the option to sell. So that means you have to buy at 100 and sell at 50. So that will be a loss for you of 50, and you will never exercise the option if you are in losses. So you let the option lapse, and only what is the loss for you? The 5 rupees premium what you paid for entering into this option contract. Okay, so that is what is the explanation for this. Now, types of real options include the following. Timing options allow a company to delay making an investment because it expects to have better information in the future. Yeah, so I already told you options are always exercised when you have some benefit from them, or if you are profitable from that. So you can, if you have timing options, you can wait for the right and ideal time and you can make your investment. Okay, when you get better information about that particular project in the future. Abandonment option is nothing but you can abandon the project, leave the project or exit the project if you don't feel like it is going to give you any incremental cash flows or it is going to increase cost for you. Expansion options or growth options, that means you have the option to, like, like create more value for your company. Okay, and you can do additional investments in the future. Flexibility options give managers choices regarding, see, these all options are there. So these options give managers choices regarding the operational aspects of a project. The two main forms are price setting and production flexibility options. That means they have the flexibility of setting the prices according to scenario or situation, and also they have the flexibility of production. That means if when they want to produce, they can decide, and they may ask the workers to work for more overtime, and they can use different materials and inputs and produce a variety of products. Fundamental options are projects that are options themselves because the payoffs depend on price of an underlying asset. I have already explained you about fundamental options, call option and put option. Okay, that that you can do in any case. You can also trade in commodities by using options. Commodities like crude oil, copper, zinc, anything. Okay, and you can fix the price today itself, and in the future you can buy at that price what you have fixed, and the prices go up, you can sell and make good profits. And if you see, there are two things here. Call option, if you have bullish sentiments, this is more often used by the speculators who want to make profit from the price rise. And put option is more better for hedgers. Hedgers are the one who wants to hedge or minimize their risk by fixing a price today itself, which they always want to secure. That means one price they are fixing, like farmers want to sell their produce, whatever they produce from the agricultural field, at some fixed price. That means that is the minimum price they want always. Below that, if they get, it is, loss making deal for them. Okay, so they go for put options. Fine. So one way companies can include real options in their project analysis is to estimate their value and add it to NPV. That means if with the help of those options, if you are getting good deals and it is, creating good value, you can add to the project value. You can add that value to the project value. This can incorporate available techniques such as option pricing, models, or decision trees. Another approach is to simply consider NPV without real options to be the project's minimum value. That means it's upon you. If you consider options also, you can consider and add to the NPV value, and you can see whether the project is profitable for you or not, or you can leave all these options aside and also do your NPV calculation and check whether the project is going to be profitable for you or not. Okay, you as a manager of the company may decide what is better and ideal for your company, and because you are the one who is going to make the policies. Okay, so give me 2 minutes of time. I'm calling again because again, like we are entering into a new chapter. So we'll take up that one. Give me 2 minutes of time. I'm calling 2 or 5, just 2 to 5 minutes. I'm calling again and we're doing business models. Okay. Because separate video would be there for that. So thank you. I'm calling.